They actually did it. While you were watching the news about inflation, while the mainstream media was distracting you with political drama and celebrity gossip, while the financial press was debating whether the Fed would cut rates by a quarter point or a half point, something happened in Washington that changed everything about your relationship with your bank. They activated it. The emergency banking regulation that has been sitting dormant since 2010. The provision that gives regulators sweeping powers over your deposits. The authority that allows them to limit how much of your own money you can withdraw from your own account. And it takes effect immediately for 90 days with a possibility of indefinite extension. This is not a drill. This is not a hypothetical scenario I'm warning you about. This is happening right now. Ladies and gentlemen, welcome to Finance Reality. I have spent the last 72 hours reading the regulatory filings, analyzing the legal language, speaking with banking insiders, consulting with attorneys, and piecing together exactly what just happened and what it means for your money. What I found is terrifying. The powers that have been activated go far beyond what most Americans realize is possible. The restrictions that can now be imposed make the bank runs of 2008 look like minor inconveniences. The precedent being set opens the door to full-scale financial repression. The government is not seizing your bank account, not yet, but they have just given themselves the legal authority to control when, how, and how much of your money you can access. They have positioned themselves between you and your deposits. They have transformed your checking account from private property into a government-supervised holding cell. This is not a conspiracy theory. This is published in the Federal Register. This is on the FDIC website, if you know where to look. This is the activation of powers that were designed for crisis and are now being deployed in what they claim is a precautionary measure. The question is not whether this affects you. If you have a bank account, it affects you. The question is whether you understand what is happening and whether you have taken steps to protect yourself. I'm going to break down exactly what powers have been activated, exactly what restrictions can be imposed, exactly why this is happening now, and exactly what you need to do immediately to protect your financial access. This is the most important video I have made about the banking system, and your window to act is closing fast. Let me show you exactly what was activated and what it authorizes. Let me take you through the regulatory language so you understand precisely what is now in effect. The authority comes from Section 11C3 of the Federal Deposit Insurance Act, combined with emergency provisions in the Dodd-Frank Wall Street Reform Act of 2010. These provisions grant the FDIC, the Federal Reserve, and the Treasury Department coordinated emergency powers during periods of what they define as systemic financial stress. The trigger was pulled 3 days ago. A joint memorandum from the Federal Reserve Board, the FDIC, and the Office of the Comptroller of the Currency was filed with minimal public notice. The memorandum invokes Emergency Stabilization Authority for a period of 90 days, effective immediately. Here is what the activation authorizes. First, participating financial institutions may impose temporary withdrawal limits on deposit accounts. The regulation specifies that limits may range from $500 to $5,000 per day per account holder at the discretion of the institution, with regulatory approval. Let me repeat that your bank can now limit you to withdrawing as little as $500 per day. Your money, your account, $500. If you have $50,000 in your checking account and you need it for a business payment, for a real estate closing, for a family emergency, your bank can legally tell you, no, come back tomorrow and the day after and the day after that for 90 days. Second, the activation authorizes enhanced transaction monitoring and suspicious activity reporting. Banks are now required to flag and report any withdrawal pattern that suggests customers are attempting to circumvent the limits. If you withdraw $499 today and $499 tomorrow, that pattern will be flagged. Your bank will file a suspicious activity report. Your name will go into a federal database. You will be treated as a potential financial criminal for trying to access your own money. Third, the activation suspends certain provisions of the Electronic Fund Transfer Act that normally protect consumers. Specifically, the timing requirements for fund availability are suspended. Transfers that normally clear within 1 business day may now take 3 to 5 business days. Your ability to move money quickly has been legally impaired. Fourth, and this is the provision that should terrify every American, the activation authorizes what they call temporary account restrictions for large or unusual balances. The regulatory language is vague, deliberately so. But banking attorneys I have consulted interpret this as authority to freeze accounts entirely pending review if the balance or activity is deemed anomalous. Anomalous, that is the word they use. Not illegal, not suspicious. Anomalous, different from normal. If your account looks different from what the algorithm expects, it can be frozen. Now, let me tell you how this was announced. It was not announced. There was no press conference. There was no presidential address. There was no explanation to the American people that their banking rights had just been fundamentally altered. The memorandum was filed with the Federal Register on a Friday afternoon, the classic time for burying news that you do not want people to see. It was posted on the FDIC website in a subsection that most people would never find. The major news networks did not cover it. The financial press gave it a few paragraphs, buried in articles about other topics. Most Americans have no idea this has happened. They will find out when they go to their bank and discover they cannot access their money. They will find out when their wire transfer is delayed for days. They will find out when their account is frozen for review. The banks know they received detailed implementation guidance over the weekend. Internal memos have gone out to branch managers. Systems have been updated. The infrastructure for restricting your access is already in place. I have spoken with 2 banking insiders who confirmed this. They are not happy about it. They know it will cause customer fury, but they have been told to comply and to frame the restrictions as temporary measures for financial stability. Financial stability. That is the phrase they use. Your inability to access your money is for financial stability, the stability of the banks, not the stability of your life. Now, let me explain why this is happening. Now, let me give you the context that makes sense of this emergency activation. The government does not invoke emergency banking powers casually. These authorities have existed since 2010, passed in the aftermath of the financial crisis. They were designed as a last resort, a tool to prevent bank runs and systemic collapse in genuine emergencies. For 14 years, these powers sat unused. They were there, latent, a sword hanging over the banking system that regulators could draw if necessary. But they never drew it, or drew. Not during the European debt crisis, not during the COVID crash, not during the regional bank failures of 2023. So what changed? What is happening now that triggered the activation? 3 factors converged to create what regulators apparently view as a systemic threat. First, the commercial real estate collapse has accelerated beyond what the banks can absorb. Office buildings in major cities are now worth 40 to 60% less than their outstanding mortgages. Banks that lent against these properties are staring at hundreds of billions of dollars in losses. The extend and pretend strategy, where banks refinance troubled loans and hoped values would recover, has run out of road. The loans are coming due. The borrowers cannot pay. The properties cannot be sold for anywhere near the debt. The losses must be recognized. Banks that appear healthy on paper are actually insolvent on a mark-to-market basis. If depositors realized this and withdrew their funds, dozens of regional banks would fail. The FDIC insurance fund would be exhausted within weeks. The contagion would spread to larger banks. Second, unrealized losses on treasury bonds have reached catastrophic levels. Banks bought long-term treasury bonds when interest rates were near zero. They paid par value for bonds yielding 2%. Now those same bonds yield 5%. The mark-to-market loss is 30 to 40%. The banking system is sitting on over $600 billion in unrealized treasury losses. These losses do not appear on income statements under current accounting rules, but they are real. If banks had to sell those bonds to meet withdrawals, they would realize massive losses that would wipe out their capital. This is the same dynamic that killed Silicon Valley Bank. It is happening across the entire banking system. The only difference is that regulators are trying to prevent the runs before they start. Third, the derivative exposure of major banks has reached levels that defy comprehension. The top 4 U.S. banks have derivative books totaling over $200 trillion in notional value. Even tiny moves in interest rates or credit spreads create billions in gains or losses. The interconnection between banks through derivatives means that one failure cascades immediately to others. If Bank A cannot pay Bank B on a derivative contract, Bank B cannot pay Bank C. The chain breaks and everyone falls. Regulators are watching these pressures build. They see the stress indicators that the public does not see. They know that a trigger event, a failed auction, a surprise bankruptcy, a geopolitical shock could start a cascade that they cannot stop. The emergency powers are their attempt to prevent that cascade by taking the option of bank runs off the table if depositors cannot withdraw their money quickly. They cannot cause the runs that trigger the collapse. This is the logic. Your financial freedom is being sacrificed to protect the solvency of institutions that took reckless risks with your deposits. Now, let me explain how banks are implementing the restrictions. The regulation gives banks discretion within parameters. Some banks are setting withdrawal limits at $5,000 per day. Others are setting limits at $1,000. At least one major bank has reportedly set the limit at $500 for customers below certain balance thresholds. The limits apply to cash withdrawals, cashier checks, and outgoing wire transfers. Electronic transfers to your own accounts at other institutions are also affected. The only transactions exempt from the limits are automated bill payments and point-of-sale debit transactions. In other words, you can still pay your electric bill automatically. You can still buy groceries with your debit card, but if you need actual cash or if you want to move your money out of the bank, you're limited. Some banks are implementing tiered systems based on account history. Customers with established patterns of low withdrawal activity may face less restriction. Customers who have made large withdrawals in the past are facing tighter limits. The algorithm is watching. It knows your patterns, and it is using those patterns to determine how much of your money you can access. Now, let me run the numbers for you. Let me show you exactly what the withdrawal limits mean in practical terms for different scenarios. Scenario 1, you are a small business owner who pays employees and vendors in cash or checks. Your weekly cash needs are $15,000. Under a $500 daily limit, accessing $15,000 takes 30 days. Under a $1,000 limit, it takes 15 days. Under a $5,000 limit, it takes 3 days. For a business that operates on weekly cycles, even the highest limit is disruptive. For a business facing the lowest limit, operations become nearly impossible. Scenario 2. You are selling your house and need to provide a down payment on your next home. The down payment is $60,000. Under a $5,000 daily limit, accessing $60,000 takes 12 days. Under a $1,000 limit, it takes 60 days. Under a $500 limit, it takes 120 days, longer than the 90-day emergency period. Real estate transactions have closing deadlines. If you cannot access your funds in time, the deal falls through. You lose the house. You lose your earnest money deposit. You face potential legal action from the seller. Scenario 3, you have a family emergency, a medical crisis, a death in the family, an urgent need to travel or to pay for care. You need $10,000 immediately. Under any of the withdrawal limits, immediately is not possible. You're rationed. Your emergency must wait while the bank protects its stability. Scenario 4. You are a retiree living on your savings. Your monthly expenses are $4,000. You normally withdraw that amount at the beginning of each month. Under a $500 daily limit, accessing your monthly expenses takes 8 separate trips to the bank over 8 days. For elderly customers with mobility challenges, this is not just inconvenient, it is potentially dangerous. Now let me calculate the aggregate impact. There are approximately 300 million deposit accounts in the United States. The total deposits in the banking system exceed $17 trillion. If the average account holder wants to withdraw 1% of their balance, not even a panic, just normal precautionary behavior that represents $170 billion of withdrawal demand. If withdrawal limits cap daily access at $1,000 per account, and if 10% of account holders attempt withdrawals, that is 30 million people times $1,000 equals $30 billion per day in potential demand. But the actual cash in the banking system is far less. Banks operate on fractional reserves. They do not have the cash to meet even modest withdrawal demand. That is why the limits are necessary from their perspective. The limits are not protecting you. They are protecting the banks from you. They are preventing you from taking your own money. Because if everyone took their money, the banks would fail. This is the fundamental injustice. You deposited your money in good faith. The bank lent it out, or invested it, or speculated with it. They took the risks. They got the profits. And now, when their risks are going bad, you are the one who cannot access your funds. Now let me address the exemptions and workarounds. The regulation does exempt certain transactions. Automated bill payments continue to function. Direct deposit of your paycheck continues. Debit card transactions at the point of sale continue. But here's what many people do not realize. Debit card transactions are subject to daily limits as well, typically much lower than cash withdrawal limits. If your debit card limit is $2,000 per day and you need to make a $5,000 purchase, you cannot do it. Wire transfers to other banks are explicitly covered by the restrictions. The regulators do not want you moving money out of the banking system. That defeats their purpose. What about multiple accounts at multiple banks? The regulation addresses this. Banks are required to coordinate with each other and with regulators. If you attempt to make withdrawals at multiple banks to circumvent individual limits, the pattern is flagged. You are reported. Your access may be further restricted. The system is designed to prevent escape. They have thought about the workarounds. They've closed the obvious loopholes. Now, let me explain where this is heading. Let me show you the trajectory of emergency banking powers and what you can expect in the coming weeks and months. The 90-day emergency period is not a hard limit. The regulation includes provisions for extension. If the Treasury Secretary, in consultation with the Federal Reserve and the FDIC, determines that systemic stress continues, the emergency can be extended for additional 90-day periods indefinitely. There's no requirement to justify the extension publicly. There is no congressional approval required. The executive branch has unilateral authority to keep these restrictions in place for as long as they deem necessary. The pattern with emergency powers is always the same. They are introduced as temporary. They are extended as necessary. They become permanent as the new normal. Think about the emergency powers implemented after September 11th. Temporary measures for national security that are still in place over 20 years later. Think about the COVID emergency powers. Temporary measures that lasted for years and normalized government control over daily life. Banking restrictions will follow the same path. The 90 days will become 180 days. 180 days will become a year. By the time the emergency officially ends, the infrastructure for control will be so embedded that it never really goes away. Here is what I expect over the next 12 months. First, the withdrawal limits will tighten, not loosen. As more people become aware of the restrictions and attempt to access their funds, the aggregate demand will stress the system. Regulators will respond by lowering limits further. I would not be surprised to see limits drop to $250 per day for many customers. That is barely enough for groceries and gas. It is not enough for any significant financial transaction. Second, digital payment systems will be promoted as alternatives. Regulators will frame the restrictions as applying to traditional banking while encouraging adoption of Fed-monitored digital payment systems. This serves the larger agenda of moving toward a central bank digital currency. Cannot get cash? No problem. Use our new digital system, the system that tracks every transaction. The system that can be programmed to restrict purchases the government does not approve of. Third, capital controls will expand. Today's restrictions apply to domestic withdrawals. Tomorrow's restrictions will apply to international transfers. Moving money out of the country will become increasingly difficult. We are already seeing early signs of this. Wire transfer delays for international payments, enhanced reporting requirements for foreign accounts. The net is closing. Fourth, deposit insurance will be quietly modified. The FDIC insures deposits up to $250,000 per account, but that insurance depends on the solvency of the insurance fund. The fund currently holds approximately $120 billion, a fraction of total insured deposits. If a wave of bank failures exhausts the fund, the FDIC will have to borrow from the Treasury. The Treasury will attach conditions to that borrowing. Those conditions will include permanent restrictions on depositor rights. Fifth, holding large cash balances outside banks will be stigmatized and eventually restricted. If people respond to withdrawal limits by keeping cash at home, regulators will frame this as suspicious, as potential tax evasion or money laundering. We have already seen proposals to eliminate large denomination bills, to require reporting of cash holdings above certain thresholds, to treat cash itself as evidence of criminal intent. The war on cash and the war on your banking freedom are the same war. They are two fronts in the campaign to make all money visible, controllable, and confiscatable. Now, I have to address the question that is forming in your mind. Why is the government doing this? What is the real agenda? The official justification is financial stability. The regulators will tell you that emergency powers prevent bank runs. They will tell you that withdrawal limits protect the system. They will tell you that temporary restrictions are better than permanent collapse. These justifications are not entirely fabricated. Banker runs are genuinely destructive. A cascade of failures would genuinely harm the economy. There is a legitimate argument for preventing panic, but the scale and nature of the response reveals something deeper. You do not implement sweeping withdrawal restrictions to prevent a few regional bank failures. You do not activate emergency powers that affect every bank in America because of stress in commercial real estate. The response is disproportionate to the stated threat. The real agenda is control. For decades, the ability to withdraw your money has been the ultimate check on banking and government overreach. If a bank mistreated you, you could leave. If a government policy threatened your savings, you could move them. The exit option kept power in the hands of citizens. That exit option is now closed. You can no longer vote with your feet. You can no longer take your ball and go home. Your money is trapped. The people who trapped it are telling you it is for your own good. This is the architecture of financial repression. When governments cannot pay their debts through normal means, they trap capital and extract it through inflation, through taxation, and through restrictions on alternatives. The United States government owes $34 trillion. Interest payments now exceed $1 trillion per year. There is no realistic scenario where this debt is repaid. Honestly, the only options are default, hyperinflation, or financial repression. Default is politically unacceptable. It would destroy confidence in treasury bonds and collapse the dollar's reserve currency status. Hyperinflation is economically devastating. It wipes out savings and causes social unrest. Financial repression is the quiet option. Clears throat. You trap capital in the system. You keep interest rates below inflation. You gradually steal purchasing power while maintaining the appearance of normalcy. Withdrawal limits or financial repression. They prevent you from escaping the system that is going to extract your wealth. Consider who benefits from trapped capital. Banks benefit because they do not face runs. The government benefits because Treasury yields stay low. The wealthy benefit because they have already moved their money to assets and jurisdictions beyond the restrictions. Consider who loses. Ordinary Americans with their savings and checking and savings accounts, small business owners who need cash flow to operate, retirees who depend on their deposits for living expenses. The restrictions are class warfare disguised as prudent regulation. The elites protect themselves while ordinary people are locked in. And let me address the timing. Why now? Because the window for voluntary compliance is closing. As more Americans lose faith in the banking system, as more people move to cash and precious metals and cryptocurrency, the government loses control. They need to lock the doors before more people escape. Every ounce of gold you bought was an exit from their system. Every dollar of cash you kept at home was beyond their control. Every silver coin you stacked was a vote against their monetary regime. The restrictions are their response. They are slamming the exits because too many people were leaving. If you own precious metals, if you hold cash outside the banking system, if you have taken steps to protect yourself from exactly this scenario, the activation of emergency banking powers validates everything you believed. You did not prepare because you trusted the system. You prepared precisely because you did not trust it. You saw the debt levels. You saw the money printing. You saw the fragility beneath the facade of stability, and you acted. Now the government is proving you right by activating emergency powers over deposits. They are confirming that the system cannot withstand normal market forces. They are admitting that if people were free to withdraw their money, the banks would fail. Your preparation was not paranoia. It was prudence. The same people who called you a conspiracy theorist for worrying about bank failures are now facing withdrawal limits. The same people who mocked you for holding cash are now rationed to $500 a day. Who looks foolish now? The silver and gold in your safe is not subject to withdrawal limits. The cash in your home is not trapped in a bank database. The tangible assets you accumulated are yours fully and completely without asking permission from anyone. This is what financial independence means, not trusting your wealth to institutions that can restrict your access at any time, not depending on a system that views your deposits as their resource, not being trapped when the trap springs. The emergency activation is not just a financial event. It is a philosophical vindication. It proves that the relationship between citizens and banks is not what most people believed. Your deposits are not your money in any meaningful sense. They are database entries that the bank controls and the government supervises. Real money is what you hold in your hand. Real wealth is what cannot be frozen, restricted, or confiscated with a memorandum filed on a Friday afternoon. I know what many of you are feeling right now. Anger at the violation of your rights, fear about what comes next, frustration that more people do not Watch for reports of tighter limits or frozen accounts. The situation is fluid. Stay informed. This is finance reality. I built this channel to give you information that the mainstream financial media will not provide. The activation of emergency banking powers is exactly the kind of story that gets buried. It affects everyone, but is reported nowhere. You deserve to know what is happening. You deserve time to prepare. You deserve the opportunity to protect yourself before the restrictions bite. The clock is ticking. 90 days is not very long. What you do in the coming weeks will determine whether you are trapped or free when this crisis deepens. Like this video if it helps you understand what is happening. Subscribe if you want to stay informed as this situation develops. Hit the notification bell so you do not miss the critical updates ahead. I am Finance Reality. I will see you in the next